Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is John Quealy, Chief Investment Officer of Trillium Asset Management, to discuss macro assumptions with inflation, the Fed, COVID, heading into the new school year, geopolitical risk, and ESG. John, we have a lot to unpack here. Welcome to Trade Talks.
Yeah, thanks for having me.
Let's start with the fundamental macro.
Yeah, sure. So here we are kicking off Q3, and the narrative stays the same as it's been. Inflation worries, what the Fed's going to do perhaps as early as Jackson Hole at the end of August, and core employment issues. What's the consumer thinking, and more importantly, what are the workers? Are they getting back to work? As we sit today, Jill, still almost 4 million women out of work versus pre-COVID. So we've got some short-term disruption to work through, but for now, the narrative into earnings in the very, very short term is very much the same. Fed and inflation dominates.
And you think climate initiatives and momentum around more standardized ESG disclosures and standards, why are those two the key trends in ESG?
So as we move the lens more towards an intermediate term, to your point, into the end of the year and in the beginning of 2022, these are, let's call them risks that haven't been priced into the market before. We're getting more and more data that supports climate change. We're seeing the energy sector in particular bearing the brunt. We're seeing asset managers of all type, not just Trillium, signing on to net zero pledges. So the science is clear. There are some externalities which need to get priced into stocks and in the market. One of the things that's happening later this year is a UN summit in Glasgow, Scotland, to talk about some of the initiatives that governments, if they can work together, to set some goals to try to mitigate some of these changes. This will obviously trickle down to equities, fixed income that have material exposures there.
Given these macro assumptions, where are you finding opportunities?
So a couple of things. So as Trillium, we're a 40-year specialist in ESG and responsible investing. And so we generally have a little bit of a longer term lens than what I was just talking about. We're generally in the 3 to 5 year time frame and tenor in our portfolios. And so we're looking at a mixture of secular and cyclical dynamics. And so I can give you a couple of examples from a secular perspective and then tie it into maybe some more temporal issues in the short cycle. So first, tech, not a surprise. There's so much innovation there. There's such good secular tailwind, whether it's analog to digital, whether it's electric vehicles, whether it's the movement to the cloud from off-prem. Tech offers so many compelling narratives. I will say from an ESG perspective as well, generally embraced ESG early, generally making great strides, in particular diversity. We've done a great diversity study this past Q1 with some very good tech participation. So fundamentals back us up, as well as near-term growth. As we talked about inflation, how to match the portfolio, growth helps, and tech offers a lot of that. So certainly tech is an area we're looking at. A bit to protect on the downside is the shorter cycle, and that's more of the industrials, materials weightings. And so there we're looking for, again, compelling companies with quality management teams, with protective competitive moats, business cycles, distribution channels that can help weather the storm, whether it's short-term COVID dynamics, as we talked about at the beginning of the segment, but more importantly, management teams that can pivot to transition. As we move to a low carbon economy, how do their businesses and tools and customers transform? It will take many depreciation cycles to do that. We need these industrial companies to help power that innovation. So a little bit different, short cycle. In many cases, we get a good exposure to agriculture here. Think about capital equipment makers in agriculture, as well as some of the technology providers providing some best-in-class solutions for farmers to get yields up. So industrials, and especially agriculture related, is an area we like to look at. The last one from a pro-secular perspective, not a surprise, consumer discretionary, a bedrock of the economy. The consumer's all powerful, as we talked about in the beginning, but the consumer's going through another trend, and the trend that we have seen in the past 20 years and we believe is going in the next 20 is healthy living. So it's a movement into the outer ends of your grocery store, not the middle of the aisles. It's moving toward organics. It's moving toward meatless. There's lots of innovation going on in consumer discretionary. So right now we've got some shorter cycle issues around startup and average ticket size as retail in particular, and fast restaurant, quick serve comes out of the pandemic, but really longer term preferences in the US and abroad are changing, and we want to be on top of those. So there's some very compelling ideas. Health and beauty, for example, some very important movements from a chemical footprint perspective, getting some of these shampoos and other cosmetics away from traditional chemicals into some a little bit more environmentally friendly, socially friendly alternatives. So those are some areas that we're very focused on and favorable on from a fundamental ESG, secular and cyclical perspective. One that we're not favoring here for obvious reasons is the energy sector. Even though it's been a very strong performer year to date, I think perhaps the best sector year to date, there are, back to the externalities, there are externalities that have not been priced into those models. Energy, potential climate related taxes, potential climate related liabilities, and importantly, management teams that are willing to pivot to the marketplace. So we're moving from an economy that's powered off of BTUs or British thermal units to economies that are powered off electrons. And there's plenty of different ways to do that. Again, takes years of depreciation to make that happen. We haven't seen a ton of progress there. So short term, it's a little bit of a tougher headwind for the portfolios, but longer term, we're confident in our belief of fossil fuels really moving away from a core set of a mix of a portfolio.
All right, John, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malantrino, Global Markets Reporter at Nasdaq.
Thank you.